All right, everybody, Stocks by the Numbers. Welcome back. Today is Wednesday, midday. I wanted to do a quick update here on a company that we've been watching, we've been keeping an eye on over the months, have been really performing very well for us. But now we can see that the stock is taking a big dip today on recent news with Disney and ESPN. Let's get into it. Name of the company, FuboTV Incorporated, ticker symbol FUBO, listed here on the New York Stock Exchange. Stock is now down to sub $2 here, $1.90. Still down a little over 60 cents, about 24.5% here on the day. You can see we hit a low of $1.75 and kind of slowly bounced up from there. And now we've basically been flattening out. In my opinion, we should take that next leg higher, get back above $2. Is this real? Is this an overreaction? Here's my opinion. So first of all, if this, so supposedly what happened was Disney over there, ESPN, signed this joint venture partnership deal to supposedly develop this new sports streaming service, even though they already have, ESPN, ESPN Plus or whatever. But obviously we spoke about this in the past, and that segment has been seriously struggling as of late. And the last time we looked at it, I know they were potentially talking about outside investors. They were trying to bring in some capital from the MLB or the NBA, whoever the hell it was. But anyway, at that moment, I mentioned that in my opinion, that was actually a bad look for ESPN, right? That shows weakness. That shows economic weakness, in my opinion. That if you need to bring in outside investors to raise capital to help keep your whole situation afloat, right? So now, on top of it, this is an interesting way to look at it, because if this new joint venture, we're bringing in 3 companies now, Warner Brothers, Discovery, everyone's coming in to make this sports streaming service, right? That supposedly, quote unquote, is now more competition for Fubo. Okay, first of all, think about this. If Fubo sucked, you wouldn't need to do it. So obviously, I have to personally come to the conclusion that Fubo's doing something right and probably slowly gaining market share and taking it from ESPN and other sports streaming services alike. So they felt they had their back against the wall, and they had to call in for reinforcements saying, hey, let's all come together to potentially compete against Fubo, right? So that's why the fact that the joint venture and that action was even taken to begin with leads me to believe, in my opinion, that Fubo is more than likely going to continue growing its market share and consistently increasing its revenue moving forward. But also, if this was supposedly such a bad catalyst for Fubo, we're seeing, again, the stock was down over 30% at one point. Now it seems to be slowly clawing back up, because I'm sure people are going back, they're looking at recent earnings, they're maybe seeing videos like mine, and they're seeing that a lot of people out there are basically overall bullish on Fubo. Basically what they're seeing now is, hey, listen, I could buy a stock right now that was just up at 2.5, and I can buy it for less than $2 a share right now. So in my opinion, I think a lot of people are piling in here, as we say, one of my old sayings, buy the dip, sell the rip. But more importantly, if this was such a bad look for Fubo, and we're beating Fubo up, then by contrast, we should be rewarding Disney, right? Because if they're supposedly bringing in 2-3 other corporations and they're making this joint venture new sports streaming service, then supposedly it's going to kick ass and take names and regain that market share that it lost to other sports streaming services like Fubo. Well, then don't you think the stock should be up instead of down? And what you're seeing here today is that Disney, to my knowledge, has been red all day and is currently sitting here down 0.5% still, with about 2.5 hours left to go in the trading session. So what that tells me is a couple of things. First of all, ESPN needed to do this and bring in other people because they were struggling. Also, ESPN and these other companies felt it would be a good idea because they see how well other sports streaming services have been performing as of late, specifically Fubo. And again, if this is a bad look for Fubo and they're down 20 or 30%, then you'd think you'd get a big bump in these other companies like Disney. Now, obviously, Warner Brothers and the outside corporations being brought in are seeing a little bit of a pop today because technically that's good news for them. But again, if ESPN is struggling and feels they have to bring in 2 or 3 other companies to make this brand new service to compete supposedly with Fubo, then again, that in my opinion is actually a very bad catalyst for ESPN and Disney, and they should not be rewarded in my opinion based on this recent news. So again, I'm going to go on record saying, as long as Fubo keeps doing what they're doing, again, beating revenue estimates for the last 4 quarters in a row, if you go back, stock was down at $1, even dipped below $1, and then almost hit $4 in the couple of quarters after we initially looked at it like a year ago, whenever it was. So Fubo has been doing phenomenally well. So the fact that they're even taking this hit today, in my opinion, I think that this is a massive overreaction. And even here at 190, in my opinion, I would personally be a buyer. And if they do want to continue to sell it off back down into the 180s and the 170s, I would probably more than likely continue to accumulate a position. Now the market cap back down to about $500 million, and the company's bringing in $300-400 million a quarter. So obviously, looking at the numbers, in my opinion, the stock is now again massively undervalued in the numbers. When it was up at 3+, maybe you can make the argument that it was fair value, but now it's almost down half of that. So again, if we liked it up at $2.50, $3, we love it down here at sub $2. But overall, again, the overall message that I'm seeing is that ESPN is struggling, Fubo is growing, Disney had to make a move, they had to bring in outside investors because they're struggling, and a company like Fubo has not been struggling. And of course, on top of it, we had recent news roughly, I think it was about 2 weeks ago here. Let me check. Look, Fubo TV slides as new sports streaming app fuels competition concerns. Remember, they had to make the move. And I love these reactions. The fact that this announcement, this announcement will be made, and then all of a sudden something like Fubo drops 25-30%. First of all, in my eyes, it's only dropping that much because it's still being kept at these small micro cap levels, right? The company, in my opinion, should have a market cap north of at least $1 billion plus right now, which technically would be roughly a double from this point, which again would bring us to high 3s, potentially low 4s, which is why I still say, in my opinion, Fubo is a $4 stock in my eyes. But you can see here, going back to January 26, roughly 2 weeks ago, you can see that Fubo TV recently invested into Bare Knuckle Fighting Championship, BKFC. And BKFC has actually been growing very nicely, especially over the last several months, and the last 12 months specifically. I know they have Mike Perry over there is now the face of BKFC. The guy's an absolute violent animal. He calls himself the king of violence, and all of his fights are usually exciting, and I would presume that those are the best events that they have where they get the most pay-per-view buys. But more importantly, first of all, if Fubo is investing into like a growing up-and-coming sport like BKFC, then obviously there's growth there. But of course, Fubo is already doing decent business, so now the new investment into BKFC is more than likely going to just fuel further business and further growth. So overall, I still see nothing but positives for Fubo. And also, the overreaction here with this percentage drop, again, it makes me laugh because this was just announced. The app is not even up and running. We do not know the prices. We do not know how it's going to be laid out, where it is, what's going on. And just the fact that the announcement was made, we have something like Fubo taking a 20+% drop here today. So this is why I say this is a massive overreaction. And of course, more importantly, if we switch over to Disney, as you see here, article from CNBC, which randomly now the article is missing, supposedly likely deleted, as we're being told here on TradingView. Who knows? But look at this. sports streaming platform, including Disney, Fox, to cost above $40 per month. So now this supposed kick-ass new sports streaming app that is going to compete with Fubo and take a chunk of their business away is now going to cost you potentially around $500 a year, if not more, for this sports streaming service. And people have already been busting chops of Dana White and the people at ESPN because of the price of ESPN Plus and the consistent increases in the price of UFC pay-per-views as well. The UFC has been essentially consistently increasing the price of their pay-per-view basically year over year. And I'm not exactly sure if that's going to stop anytime soon. But basically now, if you want to watch one of these UFC pay-per-view events, you need to have a subscription to ESPN Plus, right? Because everyone and their brother now has a subscription. As long as you're paying us monthly for something, you know, then everything's okay. But long story short, you now need to pay monthly for ESPN Plus, and then on the night of the pay-per-view, you now have to pay an even higher price to watch the UFC, main card. And listen, granted, perhaps I'm a little biased because I have been watching MMA recently, so I appreciate the UFC, and I can understand that, they're viewing themselves as one of the, more watched growing sports who, potentially could make the argument that they put on a little bit of a better show for the people. They give you a little bit more bang for your buck. It's more exciting. So I can appreciate the fact that really since they went public, they have been slowly and steadily increasing that pay-per-view price. I can appreciate that. But also at the same time, it does kind of cost an arm and a leg if you want to be an ESPN Plus subscriber and pay every month for these UFC pay-per-view events. And now you had something cheaper in a growing company like Fubo, and now they're investing into something also in the combat sports sector with BKFC, and that's why I feel, just overall looking at the situation, I feel like this is actually a really big win for Fubo, not a loss. And I actually think this is a loss for Disney, not necessarily a win. So people are looking at this again like, oh, they're making this new sports streaming service. They're going to reclaim, all the viewership that they lost, and it's going to be great. Again, going to cost you over $500 a year. Technically, we don't know because that article was randomly deleted. But that was from CNBC that supposedly said that this new sports streaming service was going to cost over $40 a month. Okay? And the reason why it's so expensive also, think about this. ESPN Plus is what? I don't know, $12, $15 a month. I don't even know. But now you're bringing in two other companies. And what do you think those companies are saying? Hey, if you want us involved, we need $12, $14, $15 a month also. So now you have to take that $14, $15 a month original cost and you have to multiply it by 3 because everyone now has their hand in the honey pot. So now, instead of $15 a month, it's going to be $42, $45 a month because you have to make everyone happy. You have to make everyone money. So again, I can appreciate the fact that they're trying to go down a little bit of a different avenue and try to, regain this viewership. But at the end of the day, I just think that it's the smaller, potentially less greedy companies like Fubo that have been benefiting over the last couple of years off of the struggles of a media powerhouse company like Disney. So, again, in my opinion, I still like Fubo because off of this news, the business of Fubo has not changed. And if we come down here, we have earnings in about 15 days, set to report February 22nd. So we got about 2 weeks for these earnings to come out. And in my opinion, I still have high conviction on Fubo. I personally feel that they're probably going to beat revenue estimates again. And then, of course, off of that good news, the stock obviously should technically pop back up well above $2 a share. But again, in my opinion, this move today is just a massive overreaction. And if I was in Fubo, I would personally view this as a positive. If you recently purchased shares of Fubo, in my opinion, over at, $2.50, $2.70, whatever your cost is, and now today, you're down big and it's sub $2, in my opinion, I would personally add to the position because I just feel like we have more potential future growth with a stock like Fubo as opposed to trying to pick up shares of something like a Disney now on the hopes that this new joint venture is going to be successful and it's going to work out, right? Because that's what I mean. This is the way, in my opinion, Wall Street works, right? Because the news hits, Disney, again, not rewarded, down 0.5%, right? So it's obviously not good news for Disney. But supposedly, they're saying it's bad news for Fubo and it's down 20-30%. But now, potentially, we may see several months now moving forward, all of a sudden, the app sucks, user reviews may come out negative, people may say, you're crazy, I'm not paying you $45 a month. That they may fall below user expectations, monthly payment expectations. They may be expecting, who knows, 100, 200 million in the first 3 months after they launch this new sports streaming app. And for all we know, they may only bring in like 30 million and completely fall short of that mark. And it may potentially turn out to be a disaster. But again, what's going to happen is it's going to be more of a disaster for Disney because they're the ones giving up their share to bring in these other companies. So the other companies like Discovery, Warner Brothers, chances are, in my opinion, they'll be fine. And this is looking like just a straight positive for those stocks. But on the flip side, I actually think, in my opinion, this is basically the beginning of a shit show for a company like Disney. And again, the business of Fubo has not changed at all off of this news. And just the fact that it was announced, Fubo is being taken to the shed. And I have to say what I always say. If I liked it up at 2.5, I love it down here at sub 2. Let's look at stock charts very quickly. I'll let you go. As you see on this news, we completely broke down out of our Bollinger Bands. The MACD looks incredibly low here, in my opinion. Fell off a cliff. Of course, I understand, and it turned downward here on this news, on this big drop. But in my opinion, it really should bottom out soon and begin to curl. Even if we see that, 168, 69 level, whatever we were talking about, that's only a slight dip from where we currently are. So even if it does potentially touch that level, it really should, in my opinion, find that footing there and bounce and have everything curl back to the upside. And of course, we know that with a company like Fubo that has been consistently beating on the revenue side on these earnings for at least the last 4 quarters in a row, chances are it's going to have some bullish momentum and a little bit of a rally going into these earnings coming out in about 2 weeks, right? So that's why I'm saying, in my opinion, it will most likely reclaim like this 2.25, 2.5 mark probably going into earnings. And if not, then they may probably have the potential to beat on those earnings and then see even a bigger pop afterwards. Because then you may see articles like, Fubo, took a hit when Disney made the announcement, but the company's, still rolling on all cylinders and they just beat earnings again and the stock is up 20-30%. You understand what I'm saying? So this is, in my opinion, the true test of investing. Did anything change with Fubo? And in my opinion, the answer is no. Which again brings me back to some of my more original rules. These sayings that I always say, things like we know what we know who the winners are, follow the revenue, follow the money, follow the growth, which Fubo has been showing us in the numbers. Buy the dips, sell the rips. If we liked it up at $3, $2.50, now it's all you can eat down here at $1.80, $1.60, wherever the hell it goes. It doesn't matter. In my eyes, you should essentially be looking at this as we have a stock that was 2.5, 3, 3.60, and now it's $1.80. That is, in my opinion, how I personally am looking at this. And if you agree or disagree, let me know down in the comments section. But now we can see, again, looking at the daily, we can see that the RSI basically stays between our benchmark levels of 30 and 70. And we can see today on this news, the RSI has now dipped below 30, sitting here a little over 25.5. So I'm telling you, in my opinion, there are probably a lot of traders, a lot of investors out there who have been watching the situation of Fubo, see that the company is beating earnings, see that the company took a big dip, they see that the RSI is now down below 30, and chances are they're probably stepping in and beginning to build a position down here on this big sell-off. Because remember, when it was up here at $273, they missed out on it, right? They didn't know what we know. So they're looking at the chart saying, damn, they've been beating earnings. Look at this. You know, all these months ago, the stock was down at $1. I knew it. I should have bought it. Now it's sitting here. It's holding $2.5, $3. I missed the boat, right? I missed it. Now is their opportunity. So this is, again, where the discipline comes in. Switch over to the weekly very quickly. We can see the weekly RSI now. Again, this was before the rebound really happened, right? This was after the reverse stock split and the company was coming out with negative catalysts. So we can understand that the RSI was sub 30 at this point because the negative catalysts were outweighing any potential short-term technicals that we could have seen there in the moment. However, since then, you can see again, even on the weekly, that the stock has basically been staying inside of those benchmark levels of 30 to 70. And now we can see that the RSI on the weekly is sitting here at roughly 37 2/3, right? So we could make the argument saying, hey, it's technically not at 30, so they could take it a little bit lower again, back into the 170s, the 160s, and then that could potentially line up the RSI here on the weekly, down here at 30, low 30s, sub 30, and then it could potentially find its footing, find the bottom, and then have the bounce, try to fill that gap up that it just gapped down from, and of course, potentially have some bullish momentum and go into a little bit of a rally going into these earnings coming up again, February 22nd, roughly 2 weeks from today. So again, this is why I say looking at a lot of these technicals along with the numbers, I still say, in my opinion, even if it slightly goes down first, I personally would still be a buyer. I would not be getting anxious or scared or frustrated or nervous in this situation. If anyone's boots should be shaking right now, it should be Disney's. It should not be Fubo's. And I'm going to end it there. So once again, this is Stocks by the Numbers. I want to thank you guys for stopping by. If you have any questions, comments, or concerns, please drop it down in the comments section. I'm usually very quick to reply. Thumbs up algorithm helps me get more eyes on the channel. And of course, subscribe to the channel. That is our handshake agreement. That is how you help me help you. But moving forward, more importantly, like I always say, I understand that markets are rocky and they're volatile and they are very uncertain. So I want to wish all of you success. I hope everyone makes a couple of dollars. Thanks for stopping by. See you in the next one.